It's not just U.S. investors who drive U.S. markets. We also pay attention to foreign investors in U.S. securities. And Torsten Slok of Apollo is here with one of his charts to show where foreign investors are putting their money.
So before the pandemic, there was appetite among foreigners for buying, in particular, U.S. government bonds and also U.S. equities. Foreigners have also historically bought a lot of U.S. credit, but broadly speaking, the trends were that foreigners had appetite for buying both U.S. fixed income and buying U.S. equities. So over the months ahead, we still have that the Federal Reserve is doing quantitative tightening to the tune of roughly $60 billion every single month. At the same time, we also have a budget deficit, which is roughly around 5% of GDP, and that amounts to roughly, in round numbers, about $100 billion in issuance of treasuries every single month. Combining both QT and the budget deficit with this new issuance on the other side of this debt ceiling deal now potentially being quite substantial, it does raise questions about who is it that will be buying treasuries, in particular in an environment where the hedging costs for foreigners continue to be quite elevated.
Erin Browne of Pimco and Barbara Reinhard of Voya are still with us. So, Erin, let me start with you here. We've been following this after the debt ceiling got put behind us, as fortunately it did this week. There's the question of replenishing the larder, essentially, in the U.S. Treasury to get their stock back up. It's going to be a lot of T-bills. Do we have the buyers for those T-bills?
Yeah, as Torsten mentioned, I mean, the challenge is from a foreigner's perspective. If you're a Japanese investor and you're looking to buy 10-year government bonds, after the FX hedging cost measured by the sort of 3-month, FX forward hedge, it will cost you -2%. Your yield that you're getting is about -2.2% on a 10-year bond. You can buy JGBs for about 40 basis points. So from a foreigner's perspective, it's better to buy the local bonds than to take into account the FX hedging costs and buy a U.S. Treasury bond, even though U.S. Treasuries, at least from a yield perspective in the U.S., is yielding more. So it's really unattractive right now just because of FX hedging costs to buy U.S. government bonds from a foreigner's perspective. You know, there's another a wrinkle that I'm going to throw into, the challenge that we have with respect to supply. Not only do we need to refill the coffers of the TGA, and we have to fund the fiscal deficit, but also keep in mind from an international perspective, you're going to start to have the TLTROs also that are going to start adding to additional supply in Europe as well. So you have a lot of government supply that's going to be hitting the market in the second half of this year, which is going to create a challenge, certainly in terms of, or raise the question in terms of who's going to be the incremental buyer for that. The problem with the debt ceiling being passed, I mean, it's good from a political perspective and good from a stability perspective, but it does mean that you now have to refill those coffers. There's going to be a significant amount of issuance over the next couple of months, and the Treasury is saying that they want to rebuild to about $600 billion, that TGA, which means a significant amount of issuance over the next 3 to 4 months.
So, Barbara, I must confess, I hadn't thought about the TLTRO issue, but whatever it is, what's it going to do to liquidity in the marketplace, and what could that mean as a practical matter? That money's got to come from someplace.
It does, but a lot of times you're talking about cash buyers moving over to a different cash instrument. In the past 20 years, there have been 4 times that the Treasury General Account has had to raise significant amount of assets, like it is this time. Each time it was able to do it without an issue. We don't rule out that something could potentially be amiss this time and cause some indigestion, but the Fed is very well versed in the plumbing of the Treasury market, and we don't think that it's necessarily going to be a very big issue for the front end market. Plus, also think about this: you're now getting interest rates that are almost in excess of headline inflation to be parked in T-bills, right? So it's just a very attractive investment for many investors, and many of the bank depositors are looking at the T-bill market thinking, I can go over to money markets and get much better rates of interest. So I think there's going to be a lot of natural buyers.
What does that mean potentially for the banks, actually, for their capacity to lend, Barbara? Because that sounds good from the depositor's point of view, but what if from the bank's point of view, they may not have as much to lend?
I don't think that JP Morgan's going to have a problem with that. Not speaking about a company very specifically, but I do think that, look, the smaller regional banks do have the issue with commercial real estate and with local lending. That's a little bit of a different story, but but those are not your big money market. Those are not your big money market buyers. Your big buyers that are coming from the significant amount of deposits that are in the major money center banks, I don't think you're going to have an issue with it. The TGA should be able to be refunded with very little problems in the market.
Erin, I interrupted you.
No. So I take a slightly different approach. I think that there's two ways or two liabilities that need to adjust lower as the TGA gets rebuilt. The first is through the reverse repo facility. Now, as Barbara said, if you had TGA rebuild be very cleanly met with a reverse repo offset. So as TGA goes up, reverse repos go down, then that should have no impact on liquidity. However, I do think that restrictions are going to emerge, particularly because right now the banks or money markets are getting a really good deal by parking the money at the Fed. They're getting 5 basis points over the 5% level. So they're getting about 5.05%. Right now, Treasury bills have been trading below that.
Yeah.
So that means that to make it attractive for money markets to move over into buying bills, you're going to have to see bills go up in yield. The second is that with respect to bank reserves, as reserves leave the system, that does put, that generally means that deposits are leaving banks. And that generally means that it hurts credit creation in the general economy. So I actually think it's going to be a bigger impact on liquidity.